It is showtime. Welcome to another Taxes in Retirement Live. I am Andy Panko, owner of Tenon Financial. Let me get rid of that. Special once a month. Where are we here? Here we go. Mailbag, Ask Andy Anything. That is tonight. I did get a few questions sent in beforehand. Otherwise, feel free to drop your questions live in the comments. I have no agenda, nothing else planned other than these few questions that came in before. So open mic, whatever you all would like to discuss or have addressed, feel free to let me know. Again, it is, wait for it, mailbag. That's a mailbox, technically. I should probably find a bag. But whatever, I digress. Let me do the dad jokes and then the disclaimer. Starting with, initially I didn't believe my chiropractor was any good, but now I stand corrected. Straightened me right out. Next, I said to the gym instructor, can you teach me how to do splits? He said, how flexible are you? I said, I can make Tuesdays. My calendar's good. Flexibility, not so much, but my calendar's free. And finally, my wife told me I was immature. So I told her to get out of my pillow fort. Don't let the dragon bite you on the way out. It's my world, my kingdom. All right, that's the dad jokes. Let me see, comments are working. Very cool. Okay, great. Someone just, okay, I'll come back to that. Disclaimer, before we get into it, this video is only general explanations and education. It is not specific tax, legal, or investment advice. Before considering acting on anything you see in this video, first consult with your tax, legal, or investment advisor, which I am not, unless you do happen to be one of my clients, in which case, sure, we will talk about all this stuff in great detail and specific advice offline outside of the public forum of Facebook. For purposes of tonight, this is general helpful hints and education. It is not specific advice to you or your circumstances. Thank you very much. All right, so let's do it. Let me start with the few questions I got ahead of time. Dave Fultz, 3 from Dave Fultz. One of them is kind of a throwaway question, but 2 from Dave Fultz, let's say, and then a third. First one, in terms of tax-efficient retirement planning, what are the 3 most important ideas to consider? Great question, Dave Fultz. So I had a hard time coming up with just 3. I mean, basically everything we talk about in this group is all things to consider, and I think people who are been in the group a while kind of have a decent enough handle about the topics and the hot words and the whatever. But 3 general things I came up with about tax-efficient retirement planning. 1, federal tax environment today is generationally low, and it is likely the lowest it will ever be for the rest of any of our lives. We know, I say this all the time, I feel like a broken record, but we know, objectively speaking, that the current federal tax rates, the marginal tax rates, and other provisions of the federal tax code are, again, historically low, and we know that they're going back up some in starting January 2026, if not sooner. So why January 2026? For those who don't know, so the Tax Cuts and Jobs Act is what's otherwise known as the Trump tax cuts, if you will. Most of the provisions went into place effective January 2018. So we got a tax rate reduction coming from 2017 into 2018. Now, some people's taxes went up depending on where you live, and there's something called the SALT tax, the state and local tax deduction on your tax return, that got capped. So people in high cost states, it could possibly have hurt them such that their taxes were higher. But generally speaking, the vast majority of Americans saw a tax reduction, federal tax reduction, starting in 2018. Those were already preset to expire effective January 2026. So we already know that's going to happen. Now it's fairly safe to guess that those rates may get rolled back or otherwise changed/increased prior to 2026. President Biden's talking tonight at 9 p.m. Eastern about his new, I think $1 or $1.8 trillion plan. He wants to try to get some support behind. So the writing's on the wall. Taxes will go up. When, by how much, in what way, shape, and form they'll take, that all remains to be seen. But we know, objectively speaking, federal taxes now are probably the lowest we'll ever see them. So that's one thing to consider in planning for retirement. In other words, take advantage of today's taxes if you can, perhaps pay more than you otherwise would, because we know taxes will be higher. That's one. The second important idea with tax-efficient retirement planning is it's not just tax rates today, the pure marginal tax brackets today and or your total income today versus what it will be in the future. There's other sort of retirement specific or kind of sneakier hidden taxes that come into play. So the conventional logic with why people would typically choose to do tax deferred contributions, whether it's an employer plan like a 401k or 403b or an IRA, you would do it tax deferred today. So you take the tax break today with knowing that you'll eventually pay tax on it in the future. Now, the thought process is, well, if I'm working today, I'm probably in my relatively high earning years, especially compared to retirement, when I'm assuming my income will be less because my wages will stop. So therefore, let me take the tax break now, hoping, thinking, guessing that I'll be paying less tax in the future. And if you know that to be, if you can predict the future and you know that will play out, then sure, that makes sense. But there's more to the equation than just what's the tax rate today versus what will be in the future, and what's your income today versus what will it be in the future. Those are definitely parts of it, but there's other, like I mentioned, retiree-specific taxes, like when you're 65, you have to start Medicare unless you have some qualifying other coverage. But generally speaking, everyone has to start Medicare at 65. And the premiums you pay for Medicare are based on, there's surcharges based on your total gross income, which many people don't know. And those incomes start to matter starting the year you turn 63 for Medicare premiums starting at 65. So that's something, you don't have that tax. It's a premium surcharge, but it's functionally a tax as far as I'm concerned. You don't have that when you're 30, 40, 50 years old because you're not on Medicare. It doesn't matter. So that's like a retiree-specific tax. You have to add that in and factor that in along with your assumptions of current versus future taxes. So something like that. And yes, wages may or will stop at some point, but that doesn't mean your income will necessarily be low. If you have Social Security, that'll be something. If you have a good pension, that'll be something. If you've been just squirreling money away your whole life, investing aggressively and did well, you're going to have a potentially sizable 401k or TSP or 403b. That may be a lot of income you need to pull out of that. So you may not actually be in a lower income environment in retirement than you are when you're working, believe it or not. Hold that thought. There's something else I want to touch on there in my other question. The third broad idea to keep in mind with tax efficient retirement planning is to look for opportunities to take distributions from different account types at different times. In other words, don't just let your IRA or your 401k sit there until you're forced to start taking income by way of required minimum distributions or RMDs at age 72. Look for opportunities like now in a lower tax environment to pull some of it out today, pay taxes today at relatively low rates, as opposed to just letting this tax deferral snowball and keep kicking this can down the road. So that's hard to say what's the right way to do it, but don't just let it sit and try to stay on autopilot. You kind of have to ideally actively and consciously look for opportunities where it makes sense to get ahead of some of this longer term tax by paying more now. So those are the three things. Good question, Default. So again, that was in response to, in terms of tax efficient retirement planning, what are the three most important ideas to consider? Question 2 from Defaults. When a person is heading into retirement, what are the blind spots you most often see? I thought about this one for a while, and most of the people I work with found me through outlets like this, through Facebook or the YouTube channel. So they're already pretty well educated and versed in the basics at least, but a lot of times more than that, people that I work with have pretty high levels of knowledge about all this stuff. With that said, thankfully, they're aware of the blind spots, and there's not really a lot of like gaping mistakes or problems or glaring omissions in the plan. Speaking more generally, outside of this super educated crowd that follows the Facebook group and whatever, other things, generally speaking, big one I've actually seen a handful of times through friends or word of mouth is just no will. I talked to someone yesterday, a friend of the family. Husband is turning 70, wife is 66, I think. No will yet. Right? I don't know exactly why. Never thought about it or didn't think it was needed or whatever, but no will. And presumably no other estate documents like power of attorney, healthcare, advanced medical directive. that's big. You know, and then they have children. And they've had, you know, kids are now grown and out of the house, but presumably didn't have a will decades ago when kids were young and whatever. So that's a big blind spot that I don't know if they consciously didn't do it because it's a kind of morbid discussion to talk about a will, or they weren't aware of it. I don't know. That was one big one. So estate plan in general, you know, either none at all or one that's really, you know, deficient. The other sort of blind spot people don't know about is Medicare in general. People don't know how much Medicare does not cover. A lot of people think I hit 65, cool, I'm completely covered on the subsidized Medicare, everything's great. No, base Medicare still has co-pays, deductibles, out-of-pocket amounts, monthly premiums, and there's a lot it doesn't cover. Base Medicare does not cover dental, vision, hearing aids, footwork, you know, podiatry work. There's a few glasses. I think I said that in vision. And there's one chiropractic work, things like that. So people are often taken back by that. So Medicare ends up costing more than people think it will. Another Medicare thing that's kind of a blind spot is a lot of people, again, outside of this group, I think everyone in this group is super sharp and knows of IRMA, these Medicare surcharges. People don't know about that. And, you know, they find out kind of the hard way. They get their end of year statement saying what their Medicare premium is going to be. And guess what? There's $100 or $200 excess surcharge tacked onto it. Broader sort of blind spot is simply no coordinated plan. So people kind of work their whole life, you know, for decades, maybe do a really good job saving. You spend less than you make and just plow the difference into savings or investments. And for the most part, it's relatively straightforward. I mean, maybe you bought a house along the way, help pay for college or whatever. But for the most part, you work, you save. It's not until you get near retirement that all these things converge, and now you realize you need a plan. Not only do you have assets, you know, savings and bank accounts, brokerage accounts, IRAs, you may have some straggler 401ks or 403bs from old jobs. You got this random gaggle of accounts. You may not even be sure what or where, how much is in each thing. Tie that together with Social Security. How does that play in? When to claim? If you have a pension, when to take that? If you have any annuities, or do you need annuities? Like, now's the time to consider to put this plan together. And even bigger, you know, not necessarily financial things. What's your plan for aging? We're all going to get older. You know, the body, the mind is not going to be as sharp as it is currently. Is your plan to age in place? Do you want to live into move into a continuing care community or something like that? Or is your plan family's going to take care of you when the time comes? So not having a plan, you know, it'd be good to put one together prior to starting retirement, you know, a few years before, start to really think seriously about this stuff and try to coordinate it as best as possible. And realize plans will change. Life happens, financial markets change, tax legislation changes. A plan is not, you can't predict today with accuracy what's going to happen over the next 40 years, but that doesn't mean you shouldn't try. You have to at least try with the best of your knowledge and abilities and guesstimations. Realize even in retirement, your plan will change, life will happen, things will need to evolve. So long-winded answer, but that's sort of the blind spots I see. Again, slightly different set of blind spots for those in the group because all of you are so well-versed in all this stuff already versus kind of folks who don't know nearly as much about this. And final question from Dave Fultz. Do you anticipate beginning a podcast in 2021? No. At this point, no. At the end of last year, yes, I would have said 90% sure. At the beginning of this year, I would have said 70% sure. Now, not much percent sure that I'll be doing a podcast. As of now, I have plenty of things going on. You know, my business, my paying clients, that business is growing well and faster than hoped for, which is good. So I never want any of these things I'm doing, Facebook group, whatever, to be a distraction to that. So as of now, I'm managing everything just fine, but a podcast is not, it doesn't look like it's in the cards at this point, Dave Fultz. Great question though. I still like the idea, but I don't know. I can't stretch myself too thin. So as of now, the thought is on pause. All right, that's it for Dave Fultz questions. Thank you, Dave Fultz. Let me now. And for those of you who typically jump in other comments, if I can ask, just for now, please refrain from answering other people's questions. Not because I'm concerned about you stealing my thunder, but in the streaming software, I can't see nested responses. Whether it's a new comment or a response to a comment, they all just daisy chain down in one long list. So I don't want to address something that one of you all have already addressed. All right, I'm just starting at the top here. Someone said I sent you an email 2 minutes ago. I don't know who this is from, but I did not receive any emails since 7:49 Eastern time. So whoever this is, feel free to post your question now. All right, what is this? Can you explain the difference with limit loss and stop loss options on stocks and ETF? What will trigger a sale? Thank you, Brenda. Yeah, great question. So when you buy and sell any security, let's just use stocks for now to keep it simple, there's different types of orders. You can simply go in and say, I want to buy 50 shares of this and give me whatever price I can get right now. You know, as soon as you can fill this, fill it. That's called a market order. There's no conditions or restrictions. It's simply buy me 50 shares, whatever the price is, done. You can also set limits. Limits is like, let's say a stock's trading, let me keep this question up. Let's say a stock is currently trading at 50 and I want to buy it for no more than 45. I can put it in a limit order that says buy this, buy these 100 shares only at a price that's 45 or lower. So the broker they'll keep this log basically. I mean, it's an electronic log, but they have this log batched up and it's monitoring the price of the securities. If and when those shares ever hit 45 or below, it'll execute your order and buy you those 100 shares at $45. That's a limit. You can also set losses like a stop loss. So instead of buying a security, let's assume you already own something. You own shares trading at 100, and you're concerned, what if they drop below 80? You don't want to cut your losses at that point. You don't want to keep holding on to it. If and when it hits 80, just automatically sell them, get out of it, cut the losses. So you can do that. So you would put that order into broker, say, I have these 100 shares. They're currently trading at $100 per share. If and when they hit 80, as soon as they hit 80, sell them. Sell all 100 shares because I don't want to risk any more loss on this. So that would be called a stop loss order, Brenda. Limit loss, I'm not familiar with the term limit loss. There's a few different combinations of these options and things we can do. Stop loss, I just explained. Limit loss, I'm not sure. But anyway, hopefully that gives you some decent food for thought about how these limits work. You can use them on buys, on sells, etc. Good question. Do you think the age for Medicare will be lowered? How will that affect tax? I have no idea. It'd be nice if it was, but you got to pay for that, right? And I'm pretty centrist in basically most aspects of life, political and fiscal and social things combined. It would be nice if there was some form of socialized medicine, which Medicare is, more accessible to people. Like I've seen too many cases firsthand where someone wants to leave to start a business, and generally speaking, capitalism is great. Start a business, build something, create value from nothing. That's the American dream. Well, there's lots of people hamstrung because they don't have medical benefits, and it's too expensive to pay a couple $1,000 out of pocket per month for premiums, plus co-pays and stuff on top of it. That people are kind of shackled to employers, to having to work for someone else simply to get benefits. That doesn't quite sit well with me, but it is what it is. And I realize you can't just give free or heavily subsidized insurance to everyone because someone's got to pay for it. So I don't know. It would be nice for it to be lower to 60, let's say, but that would mean you have to pay for it. So payroll taxes will go up. Instead of paying 1.45% on your payroll to Medicare, assume it would be a lot higher. Maybe there's an additional tax built into the tax code. So we're all going to pay for it one way or another. I don't know. Nothing's free. None of these programs are free. They all cost money. It's nice to have them, but they have to be paid for. So I've never really thought about that one. But yeah, if we do get something more than we're getting now, it's going to have to be paid for, which means higher taxes in some way, shape, or form. Oh, an 8606 question. Do I still need to file Form 8606 if I converted $5,000 from a pre-tax traditional IRA to a Roth? I know I need to include the amount converted on my tax return, but question the need for Form 8606 if I report the amount converted on my return. I never made after-tax contributions to this IRA. I'm trying to visualize 8606. So it sounds like you've never made after-tax contributions. Let's assume this is your first time ever doing a conversion. Yes, that conversion will need to be reported on that year's 8606 because that form is what calculates how much the conversion is taxable. In your case, it sounds like it would be all of it. I don't know. You'd have to look at the 8606 and see. I don't think you have to, because I'm trying to think what would carry over year to year. If you just did a one-time conversion and that's it, there might be a line on there that says like basis and conversions. Actually, you know what? You still do want to probably keep doing them, because there's a 5-year rule attached to each conversions. If you're under 59 and a half, that would help you backtrack and see, okay, I did a conversion in 2017, and I know that because I'm looking at my 8606 and it says on there. I don't know that it's absolutely necessary, but it's always a good practice to do it and keep doing them every year, just to get in the habit of it. Because it's more times than not, people don't do it, and it leads to a headache after the fact to try to recreate, years worth of this to try to piece together basis and things like that. So, not 100% sure, but it's a good practice to do it. Okay, so just had that question. Cody, gift tax is also a common misconception I hear weekly. Don't know what that's a reference to, but sure. Oh, Shauna, yes, okay. So Shauna, if you were the one who asked, you sent an email. Yes, I saw your email. I did reply back. My comment was, great question, but that's a thick one to try to unpack and pick apart in today's live. So Shauna had a great question and asked if I can put together some samples and scenarios of like families, or kind of a case study where what may future taxes look like, and why and when and kind of how much Roth conversions or tax planning would make sense, and sort of what will the impact be under these different scenarios. So, this group and lots of other places on the internet talk a lot about Roth conversions and blah, blah, blah. And, taxes are low now, and they are, but that doesn't mean conversions are right or necessary for everybody. Or if they are, some people may want or need to do hundreds of thousands of conversions. Some people may be like $30,000. It really all depends. So it's hard to say. But I guess, Shauna's email was possibly actually show and work through some examples. So great idea. That's something I'll try to do in one of these weekly things at some point, but it'll take me some work to scheme up some case study type things, Shauna, but thank you for that. Yeah, okay, so this looks like this was Shauna's question. Yes, this is what she emailed me before, exactly. So I just kind of ran through that verbally. Can you please discuss how to best remove excess contributions from a Roth? And Wisha. So, I mean, there's really not a best. There's only one option. I mean, as soon as you made an excess contribution, call up or email your custodian ASAP and be like, hey, I made an excess. Can you send it back to me? They'll ask you, to confirm how much was the excess, in what year was it for, and they'll simply send it back. So you can, and the reason why I say it's better to do as soon as possible is if you made an excess contribution for the 2020 calendar year, for example, you have until the tax return filing deadline, which is typically April 15th of 2021. This year is extended to May 17th, 2021. You have up until the tax filing deadline to take it out. If you do take it out, you will not be penalized on the amount of the excess contribution itself. However, any gains you had attributable to the excess while it was in there, those gains will be taxable to you for the year that the contribution was for. So let's work through an example quickly. So you put in $10,000 into your Roth IRA, and we should in 2020, and let's assume you're under 50, so your limit was $6,000. So you made a $4,000 excess contribution, and let's assume you made that contribution in September. You got $2,000 of gains on that $4,000 of excess contribution. You call up your custodian today. It's still before May 17th, so good. You'd be like, hey, sorry, but I made $4,000, too much contribution last year. Can you send that back plus any earnings attributable? They'll have to do the math to figure out the earnings attributable. So they'll send you a check for $6,000. 4,000 of it is a tax-free, penalty-free return of your excess. The other $2,000 that were the earnings thereon, that will be income for 2020. So you need to put that into your 2020 return. Not only will it be income, but if you're younger than 59 and a half, there's also going to be a 10% early withdrawal penalty on it. So that's how you do it. It's fairly straightforward, thankfully. Now, where it gets harder to do is if you left it in there for multiple years. I just had a call with someone like a week or two ago who just realized, oops, we made excess contributions like each of the last few years. and the money has stayed in there. So now, if you don't take it out by the tax return filing deadline of the year the contribution was for, there's a 6% penalty, and you have to add that 6% penalty in your tax return. So for this person, he needs to take out, it was like 2 or 3 years of excess contributions plus earnings, and he needs to go back and retroactively amend multiple years tax returns because he did not calculate and add in the 6% penalty in each year that the excess was in there. So not the end of the world. It's going to be a pain, and it's going to cost some money to do, to hire a tax return preparer to do it, if you're not doing it yourself. But it's still able to be undone. It's just more work, more cost, and more penalty involved. So that's why you want to take, as soon as you know you did excess, take it out as soon as possible. Good question. We did a $50,000 Roth conversion in January and paid the first quarter estimated tax. We would like to do an additional Roth conversion this quarter. Do we just pay the original tax and the additional amount over the next 3 quarters, or are we supposed to pay the whole tax in the same quarter we do the conversion? Yeah, estimated tax, great question, convoluted answer, because the process, the calculation for doing estimated taxes is convoluted. It will be best to, I did a live all about this in November. You can check that out on the YouTube channel. That will walk through all this, including examples and whatever. So I'll try to sum this up as succinctly as possible. The U.S. tax system is what's called a pay-as-you-go system. You're supposed to pay the taxes in the quarters you realize or recognize or have the income. With that said, the sort of logical assumption is, okay, I do a large conversion this quarter, let me pay tax this quarter. I do a large conversion next quarter, let me pay tax on that next quarter. If you do nothing in the last 2 quarters, you would think you don't have to pay tax, or pay estimated tax. And that's potentially true. Now, by default, the IRS wants you to make your estimated payments. They basically want you to figure out what you're going to owe for the year in taxes, break that up into 4 equal estimated payments, and pay those throughout the 4 quarters. But what happens if you don't know all your income for the year when you're doing this projection in January, and you end up doing a big fat conversion in December you weren't planning on? Are you out of luck? No. A couple options. One is you could make a big estimated payment in that quarter. It's a little more work on your tax return to what's called annualize your estimated tax payments, that's where you have to manually tick and tie. I had this much income in this quarter, and I applied this much tax against it. I had this much in this quarter, applied this much tax against it. That will help you minimize or avoid any potential underpayment penalties. In the absence of that, the IRS does want to see you pay your taxes evenly throughout the year. The other option, there's a few options, which is why this is a difficult answer. You can make withholdings. So not sending in estimated payments, but actually having tax withheld from wages if you have them, pensions if you have them, Social Security if you have it, annuities if you have it, or like regular IRA distributions if you have an IRA. Withholdings are kind of magical because there's no timing element. Regardless what point in the year you do a withholding, the IRS will treat it as if that was spread evenly throughout the year. So at one extreme, you can have real lumpy income throughout the year and pay no estimated taxes throughout the year. You can wait until December and say, okay, wow, I need to pay $17,000 in taxes for the year. You can simply do a withdraw, jack up your withholdings on your wages, Social Security, pension, IRA, or annuity to have 17 grand withheld. Even if it's December 31st, you withhold it then, you're good. As long as that covers your tax for the year, there's no penalty. You didn't have to actually pay it throughout the year. That's why withholdings are better, ideally, than estimated because there's no timing element. There's also a couple of things called safe harbors. I'll wrap with this. Safe harbors basically say as long as you pay or withhold or pay, at least 90% of what your final tax bill is for the year, you can avoid underpayment penalties. Or if it's at least 100% of last year's tax, you can avoid underpayment penalties. Or if you had high AGI last year, I think it's 150 grand or above, you need to pay or withhold at least 110% of what last year's taxes was. If you withhold at least that much, you won't get dinged with underpayment penalties this year. So, long-winded answer to this question. Hopefully, it provided some clarity. You may be, more confused than when you first asked the question, unfortunately, but such is the IRS rules around estimated tax payments. Again, check out, I did a live video in November all about this. That should help much more than my kind of rambling just now. Is cash taxable to beneficiaries? If so, would gifting be a great idea to minimize taxes? I'm guessing these 3 comments were all from the same person. So let me get a drink quick. Is cash taxable to beneficiaries? The answer is it depends. It depends on which type of account that cash is held. Anything held in a qualified tax-deferred account, IRA, 401k, 403b, 457, Federal Thrift Savings Plan, simple IRA, SEP IRA, those are all traditional tax-deferred vehicles. Anything in there, whether it's stocks, bonds, mutual funds, or just a big fat pot of cash, those aren't actually assets. In the eyes of the IRS, those are pots of income, specifically income which has not yet been taxed. When you die and someone inherits them, that heir then has to pay the tax on those not yet realized amounts of income. So to answer your question, if you leave a $100,000 IRA to a beneficiary and that IRA is 100 grand of cash, yes, that cash is completely taxable. Every dollar of that 100 grand they take out, they'll have to pay ordinary income tax on. In that case, cash is taxable. But if your cash is just a regular bank account, a regular brokerage account, a physical box of cash sitting in your house, that is not taxable to whoever inherits it. You die, they get it. There's no tax to them upon that transfer. Now, if they invest it, if they park it in a bank and earn interest, anything they earn on it after they get it, that interest, those gains are then taxable, but them initially getting the cash is not taxable in that case. Hopefully that makes sense. So your next question, would gifting be a great idea to minimize the taxes? So maybe. Again, it's not, when you die and leave someone cash outside of a qualified tax-deferred account, it's not taxable to them anyway. So no, there's no big rush to get it out of your name by gifting it while you're alive, as opposed to just letting it pass to them when you die, from a tax perspective at least. In that sense, no, it doesn't matter. Now, not to get too off on a tangent, but gifting in general, is that a way to help or save taxes? Not necessarily. Again, whether you gift it now or pass it, bequeath, whatever the technical word is for passing something upon your death, there's no tax to the person who gets it. Now, you can gift money during your lifetime, and for the most part, those gifts are not taxable to you, and gifts are never taxable to the recipient. But for you, the gift giver, you can only give away up to $11.7 million during your lifetime. Anything you give above and beyond that is subject to a gift tax you have to pay. And it's a graduated, I think it goes from 18 to 40%. So it may or may not be a way to help taxes, but generally speaking, no. Whether you give it away in life or give it away in death, cash outside of a tax-deferred account is not taxable to whoever receives it. Good question. Do I still believe in the 60-40 asset mix? If 40% bonds is still valid, what would you suggest investing the 40% still bonds? Or should we look at alternatives such as dividend-paying stocks, preferred stocks, or other products such as fixed index annuities? Yeah, great question. Hot topic, widely debated. Partly depends who you ask. You ask someone who sells insurance products, they'll say 60-40 is dead. You need an annuity or a cash value life insurance. You talk someone who's only investments only, they'll more likely than not say, nope, 60-40 still works. What's the right answer? Time will tell. I don't think 60-40 is completely broken, like the doomsdayers and naysayers and insurance sales folks say. I do think there's reason to think it won't be its return may not be as good as it was historically. And I'm not questioning the 60. I'm not concerned about the stock part. Yes, I do think at some point stocks will pull back, whether it's a 10% pullback, a 20%, I don't know. But I sort of want to actually see the stock market cool down a bit. But anyway, I'm not concerned about the long-term growth of a well-diversified portfolio of stocks. Now, again, that's just my opinion, my guess. I could be wrong, but I don't think there's reason to think stocks won't do well over the long term. Stocks always have nastiness and craziness along the way, but over the long term, I still think a well-diversified stock portfolio will do well for that 60. The 40 is what's called into question, because the way bonds work is they pay a coupon, an interest rate, and then that's part of your total return. The other part is the price, the price at which you buy it versus the price at which you sell it, if you sell it, as opposed to holding it until maturity. When interest rates decline throughout the financial markets, bond prices go up. And I'm going to have a live on that. I have a bond math, real geeky live lined up on the schedule I just posted the other day. So I won't get into details now, but over the last few decades, interest rates, for the most part, have been a steady decline, from double digits, high teens, 20% plus in the late 70s and 80s, to now look where interest rates are today. Depending what rate you're looking at, it's close to 0 or 1 to 2% for even, long-term US Treasury bonds. So the reason why bonds have historically done so well over the last few decades is because interest rates have steadily declined. So bond prices as a whole have kind of gone up. Now, interest rates are rock bottom or close to it. There's not a lot more room for interest rates to further drop. There's the risk is asymmetric. There's more risk rates will go up a lot as opposed to go down a lot. If and when rates go up a lot, that won't bode well for bond prices. Therefore, the 40% that would typically be in bonds may not do so well. Now, it won't necessarily get crushed, especially if you're invested in short or intermediate term bonds, because their prices won't be as susceptible to changes in interest rates. And there'll still be some interest. Bonds still throw off coupons. So what's going to happen is when interest rates rise, bonds, newly issued bonds will have higher interest rates than current bonds. So that's good. That's a positive. They'll throw off more interest, but prices of existing bonds will decline some. Will that decline in price more than offset the increase in interest? To be determined. My guess is that the bond portion of a 60-40 portfolio, especially if it's like not long-term bonds, because they'll drop much more in price than short or medium-term bonds, it's going to hover around flat-ish, hopefully earn a few percent per year on average. That's my guess. That's my hope. If it does any better, awesome. Can it do worse? Maybe, but unless we see massive runaway inflation, I don't think bonds are going to get hurt dramatically, at least not like short to medium term bonds. So is 60-40 dead? Do I still believe in it? Yes. It's not dead. I still believe in it. I personally use it for myself and with clients. Are there alternatives that could be considered? Yes. Do I think they're necessary? I don't know. Time will tell. It's not so convincing that the 40% portion is dead that you need these alternatives, but can't hurt. What are alternatives? There's not a lot out there. Indexed annuities, like we discussed, was it last week in the annuity discussion? Fixed index annuities are a decent alternative for bonds. They should grind out 3 to 5% per year on average, but they're long-term products. They're going to have surrender charges. You can't buy in and buy out of annuities quickly. You buy a fixed index annuity, you got to hold it for 5, 7, 10 years, whatever your contract term is. So it's a big commitment. You're locking up your capital. That's one of the big downsides. The upside is, no loss of principal. And if it performs as expected, it should grind out 3 to 5% per year on average, which isn't bad. Will that be better than what a well-diversified bond allocation will do? Time will tell. I don't think fixed index annuities have such a higher expected return than a well-diversified bond portfolio to completely say, yes, go ahead and do it. The surrender penalties are justified. The lack of liquidity is justified. I'm not quite convinced. So I definitely wouldn't replace the entirety of a bond portfolio with a fixed index annuity. Could it be used for a portion? Sure. How much? I don't know. Again, I'm not quite sold on the idea, but I don't think it would necessarily hurt either to lock up some of your bond money. Again, 5, 7, 10 years though in a fixed index annuity. Dividend paying stocks, no. They're still stocks. Yes, they may pay dividends, but dividends are not contractual. They can stop at any time. They can be reduced at any time. Now, there's lots of companies who've paid steady dividends for decades. So yes, it's logical to believe they'll continue performing, but maybe they won't. Like GE has been a bellwether of dividend stocks for a long time. GE stock price got crushed. the last couple of years. So when you're investing in something, you have to look at its total return, not just its dividends or interest, but also its price, what its price does along the way. Yeah, you may be getting a nice 4 or 5% dividend, but what if the share price drops by 50%? That's not cool. So I would not consider dividend stocks as an alternative to bonds. Preferred stocks, perhaps you're getting a little closer. Preferred stocks are more debt-like than they are equity, but they are technically equities in that they do pay higher dividends. But again, those aren't necessarily contractual, and you still have that potential price volatility that you may have with equity. So it's not it's not a replacement for bonds. Good question. There's no single right answer. It depends who you ask. My views are I'm not that concerned about the 60-40, especially if in retirement planning you couple that with Social Security, with pension if you have it, with potentially tapping other alternate sources of cash flow if and when needed, like home equity, whether a reverse mortgage or home equity loan of credit, whatever. You have equity in your house you can possibly monetize. If you do have cash value life insurance, you can tap that, if necessary, to get some cash flow here and there. So unless most people aren't relying completely on their portfolio. Therefore, even if the 40% and 60-40 drags a bit, it shouldn't completely crush a well-designed retirement plan, because Social Security should be optimized and pension should be optimized. So there's more to the mix than just assets. Great question. Lawyer recommended IRA trust. What is it and what is it good for? I don't know. I've never heard of the term IRA trust, honestly. Generally speaking, I don't know if he means a trust to which you leave an IRA upon your death. Generally speaking, you don't want to name trusts as beneficiaries of any tax-deferred account, like IRA, 401k, whatever, because trusts pay higher tax rates than individuals do. So you'd want to circumvent the trust and just pay the individual directly. Now, there are some exceptions. If this trust is structured properly as a conduit or see-through trust, you can avoid that trust taxation issue, and the person ultimately receiving it will be taxed. But I don't know what exactly this lawyer is referring to. Sorry. I have some non-deductible IRA contributions mixed with some pre-tax contribution. Is it possible to move that money to a Roth IRA? Also, I contributed $12,000 to a donor advised fund last year. Does that give me a break on my 2020 taxes? Okay, so 2 questions. First, you have an IRA with both pre and post-tax money. That post-tax money is called quote-unquote basis. Is it possible to move it to a Roth IRA? Yes, that move is called a conversion. You can't just simply transfer it. Anytime you take money from the tax-deferred world and put it into the Roth world, it's called the conversion. You have to pay tax on all the pre-tax money, the money that's never been taxed before, coming from the regular IRA into the Roth. You have to pay tax on it. There's something called Prorata, the Pareto rule, Proration. This is something that's figured out in Form 8606 on your tax return. If and when you do convert money from your traditional IRA to your Roth, you're going to be converting, some part of that conversion will be some of your pre-tax money, and some will be some of your after-tax money. You only have to pay tax on the pre-tax part that's converting over, not the after-tax. I'll leave it there. The calculation is basically a proration of how much pre-tax versus post-tax in your IRA, and your tax on just the pre-tax part that transfers. So yes, it's possible to convert it. You will have to pay tax on some of it. You contributed $12,000 to a donor advised fund last year. Does it give me a break on your 2020 taxes? Maybe. So whether you put that $12,000 into a donor advised fund or just gave it straight away to a religious organization or qualifying charity like Red Cross or whatever, that is a potentially deductible donation, but it's only deductible to the extent that and your other itemized deductions exceed your standard deduction on your tax return. If you're single, your standard deduction was like $12,500. If you're married filing joint, it's double that. It's like 25, give or take. I just have my newly today printed out, double-sided, color copy, laminated, helpful tax chart. So standard deduction is, I don't want to waste too much time looking at this. I should know where this is by now. I don't know if I can find. Yeah, it's like $12,000 something for single, and then double that for married folks. Well, I'll find it someday. So if you add up that $12,000 donation with your other itemized deductions, if it exceeds your standard deduction, then yes, you'll get a deduction for all those amounts. If it does not exceed your standard deduction, then you get no specific benefit for it because you would have gotten the standard deduction anyway. Not to say that donation was for nothing. I mean, hopefully it still helped the charity that you're ultimately going to give it to and, made you feel good for donating, but it won't give you any direct tax break if it does not exceed your standard deduction. Good question. I don't know how to determine if gains harvesting in a brokerage account would be a better idea than Roth conversions. What should I be thinking about? Ooh, yeah. That's a tough one. Without running lots of scenarios and what ifs and planning discussions with you, it's impossible to say. But basically, gains harvesting, I assume you're referencing, if your income is low enough, you can sell positions at gains in your regular brokerage account, and your long-term capital gains rate on it could potentially be zero if your taxable income is $40,000 or below, or $80,000 or below if you're married. So I guess your question is, do I sell some things and pay zero, maybe 15% long-term capital gains, or do I instead convert some money to Roth, get it out of my tax-deferred IRA? It's tough without running projections again and seeing, long-term what seems to make the most sense. It's impossible to say. Either way, they're both helping you save some tax now, right? So, if you don't have a lot of taxable income this year, don't let your brackets go to waste. Like, don't sit there with no taxable income and be like, yay, I paid no tax this year. No, that's a huge missed opportunity, right? Because we know taxes are going up, blah, blah, blah. Pay some tax today if you're in a low tax rate. Whether you do that by conversions and paying tax on that, or just selling some stuff at gains in your brokerage account and, realizing some basis resetting. Either way, those are both good opportunities to take advantage of otherwise low income or low tax years. I don't have a great answer as to what's the right way to do it. Can I discuss pros and cons of closed-end funds? Why isn't it widely popular? Good question. Let me get a drink. So first, what is a closed-end fund? Let's start with what it is. An open-end fund. A mutual fund is an open-end fund. The people can put money in anytime and they can take money out anytime. It is open. You can always contribute. You can subscribe to buy shares to a mutual fund. And whenever you want out, you simply say, hey, give it back, get me my money back. So the size of the fund, the total pot of assets behind the fund is always this like living, breathing, growing, shrinking thing. Closed-end funds, it's like a stock. They do an initial fundraise. They'll raise whatever, $500 million of initial investment, and they'll have an IPO, basically. They'll sell that. They have an initial fundraise. They raise the $500 million, and that's it. Then after the fact, people who want to buy that fund, you buy it from someone who already owns it, just like a stock. Like when you buy a stock, you buy shares of Microsoft. You're not buying it direct from Microsoft. You're buying it on the market from someone who already owns it. Closed-end funds are the same way. You're buying and selling from other market participants. You don't subscribe and redeem directly from the fund at that point because it's closed. Anyway, so the pros are that because it's closed and there's no risk of redemptions from the fund, they can usually invest in higher risk, less liquid stuff like physical buildings or bonds that pay higher coupons or something. That's good because they often come with higher yields, higher coupons, but there's higher risk. That's the downside. So the pro is potentially higher yield. The downside is potentially higher risk. Also, when you go to sell it, because you're not subscribing or redeeming directly to or from the fund company, you're buying and selling from market participants, you're subject to the liquidity of the market. There's going to be a spread between the price at which buyers and sellers are willing to buy and sell. That's why you can also have this kind of wild swings in price when you look to buy or sell. That's another con. That's it at a high level. There's not a lot of them relative to mutual funds. A lot of people don't know of them. They are potentially riskier than average mutual funds. Not all. Some mutual funds are real risky, but on average, I'd say they're slightly riskier because of the structures I just mentioned. Give me a moment here. Let me just open the window. It's 90 plus degrees today here in New Jersey. It's a little hot in the office. Let me just open the windows real quick. I will be right back. Hold that thought for like 20 seconds. And I'm back. Hopefully I less than 20 seconds. Okay, what's next? Do spousal heirs versus non-spousal heirs of a 457 account have different requirements in which to make distributions? From Mariel Sipman. Good question. And the answer is yes, I believe so. So 457 is a tax-deferred, technically deferred compensation plan. But you can functionally think of it like an IRA or 401k. It's money you've never paid tax on yet. I do believe the inheritance rules of 457s are just like IRAs or 401ks, or like IRAs, I should say. If a spouse inherits it, the spouse may be able to treat it like his or her own and roll it into his or her own. I take that back now that I'm saying this out loud. You know what? I don't know, actually. That's a good question. I don't know if it depends on the plan sponsor, the town or the organization you work for and have the plan from. Maybe they have different rules for spouses, for spouses versus non. But actually, I don't know, Mara. That's a good question. I will look that up after the fact. Once I started talking about it, I realized, you know what? I don't know the answer to this. If it is like an IRA, then spouses can treat it like their own and not have to take RMDs until the spouse turns 72. If it's a non-spouse, then there's going to be, it falls under the current RMD inherited rules for non-spouses, which you have to empty the account within 10 years. And there's a new wrinkle that isn't yet ironed out as of a week or two ago. The IRS issued some initial wording that made it look like there may actually be RMDs along the way for each of those 10 years. I don't know that it's actually going to be the case. So don't do anything yet. But possibly there might be RMDs within the 10 years as opposed to just having to empty it by the 10-year mark. But otherwise, no, I'm not certain about that. Adding to the product question, do you consider the bond part of the portfolio wealth preservation, reduce risk of losing money if stocks crash for an extended time? Yeah, great comment, whoever said this. And this is what I should have said. So yes, my view of the 40, the 40% bonds in a 60-40 portfolio is it's not a growth engine. You're not going to get 5-10% average annual growth going forward. If you do, great. Don't expect it. I view it as the ballast of stability, relative stability compared to the stock portion of your portfolio. Your stocks can go up 20-30% a year like they did, the last few years. They went up a lot, or they can potentially drop like 30-40%, 50%, which is what the drop was, 60% actually, during the 08 or 09 crisis was like the peak to trough. Now, granted, that was a severe scenario, but still, it's hypothetically possible. So anyway, so the bond portion is really there for stability and sort of like the bucketing withdrawal strategy. If and when you need to take money out of your portfolio and stocks are doing really well, all else equal, you want to sell some of your stocks, sell them while they're high, use those cash proceeds to meet your distribution needs. And then on the flip side, if stocks are tanking, your bonds should be flat, hopefully even doing fairly good, especially if you have a decent portion of your bonds in treasury bonds. Treasury bonds are usually a flight to quality asset. When the markets get ugly and economy's falling apart, stocks are dropping, people usually flock to treasuries, which boosts their price. So your bond portion should typically go up when stocks are going down. So if you're in a down stock scenario, you need to take money out. That's what your bonds are for. You're going to pull from your bonds because they're not going to be beaten up and down. That they'll be hopefully flat to positive. So it's really there to buffer the risky. Stocks are there for long-term growth. Stocks aren't there to be guaranteed money to pull from in the near term. That's what I consider bonds for. Again, not long-term growth. Bonds are stability. Hopefully eke out a little bit of growth year to year, but it's really just kind of a damper to the stocks, which will otherwise be volatile. Great comment. So they do have value, lots of value in that sense in the 60-40, as opposed to just parking your 40 on cash. You're going to get no loss, but you're going to, your interest is going to be goose egg or close to it. Haha, GE, not cool. Yeah, I guess it was about my comment about dividend paying stocks. GE used to be a complete bellwether for large, stable, good dividend paying stocks, and not so much anymore. Can I open a Roth IRA for my child? Depends. If your child has earned income part-time job. I don't know specifics around this. I've seen it discussed in the group before. There is some slight tweak of rules where like you can pay your child to do work around the house without the child needing to formally have like payroll taxes and stuff like that. I don't know specifics about it, but I think there's a possibility for you to pay your child for, can't just be allowance. It needs to be like, the kid's actually doing something for you, but I don't know all the details around it. But yes, children can have Roth IRAs. Yeah, exactly. So like Dave Myers, these are my sentiments exactly. Bonds did make money historically, and I think that was good. I also think that was an anomaly, albeit a multi-decade anomaly, again, because interest rates had a steady slide over the last 30, 40 years. But their intention wasn't to make a lot of money, especially now. Their intention is to not make much, but not lose much either. They'll hopefully get you something. But even if they hover around flat, that's still kind of they're doing what they're supposed to do, is my view. If you need a spendthrift type trust for your heir, is this a circumstance in which you would make the trust a beneficiary of the IRA and or 401k, looking at whether their tax of holding in a trust is the lesser evil of their heir blowing all the money, which would be very likely. I don't know if you all can hear outside now. There's one of those little cars with the big mufflers that makes the silly backfire sound every time it slows down. So when would you leave an IRA to a trust? Like I said before, generally you want to avoid it because if not structured properly, trusts will have to pay high taxes on IRAs because trusts are not people. Because they're not people, they have their own tax rates. And those tax rates, I think after like 14 grand of income, trusts are paying 37% tax on everything. As opposed to individuals, they're not paying 37% tax until you have like $500,000 or $600,000 of income, whatever the number is. So when would you potentially deal with paying more tax on things like IRAs in a trust? When you need protection and control of the money after you're gone. So like a spendthrift. A spendthrift is just a fancy word for someone who can't hold on to money. They're just going to go blow it on garbage and nonsense. If you want to protect that person from blowing through all their inheritance, yes, maybe then you want or need a trust where you can basically control that money from the grave, where you can say while you're alive, after I die, this trust is only allowed to dole out 20 grand a year to so-and-so for the rest of his or her life. That's one way. If you're leaving money to someone that has addiction problems, so you don't want him or her, blowing it on addictions and causing themselves harm, then maybe you need a trust to control how much money he or she gets. If someone is, potentially going through a bankruptcy or otherwise works in a really litigious type of work, they may be likely to get sued, more so than the average person. So you may want to protect that money from getting yanked away in a lawsuit by putting it into a trust where you're only going to dole out a little bit per year. So that's what trusts are for, protection and control. Trusts are not there to save taxes. It's protection and control. So if you want or need protection and control, then you consider leaving an IRA to a trust. Outside of that, there's really no reason to ever run an IRA through a trust or any tax-deferred vehicle through a trust because it's only going to be potential problems, not much of any upside. Mavis likes the laminated chart. Yeah, you do, Mavis. Thanks. I'm really oddly and eerily excited about this. Okay, next. You are rubbing in the laminated color-coded tax sheet. Yes. What is this? I messed up with the donation for 2020 and got no benefit from it. Poor planning on my part. I guess this was the one about the 12,000 donor advised fund. Yeah. One general thing about donations, because the standard deductions are so high now under the Tax Cuts and Jobs Act, a lot of people aren't able to itemize because they simply don't have enough. Unless you have really large medical expenses or really large donations, chances are you're not going to hit that bogey such that your itemized is higher than your standard. So what's a good strategy to do with donating is instead of doing modest sized donations every year, batch them up. Instead of doing 10,000, 10,000, 10,000 3 years in a row, do 30,000 now and then nothing, and then 30,000 wash, rinse, repeat. In the years you do the 30,000, you will be itemizing your deductions because that right there is more than your standard deduction. So that's the more tax efficient way to give to charities if you're going to be doing outright donations like that. I like what Dave Myers has to say. He's a sharp cat. Per Dan Modern's data, annualized inflation-adjusted return of 10-year bonds between 1928 and 2020, less than 2%. Remember that anytime the bond yields, yields and returns are not the same thing, are high, so too was inflation. Yeah, that's a good point, Dave Myers. So basically just saying when you strip out the impacts of inflation, the nominal amount or the total dollars of interest you're getting from your bonds aren't quite as good as they may have appeared historically because inflation was so high. So the real return is only a couple percent historically. Hence, just kind of proves the point, bonds aren't there to make a lot of money, especially net of inflation. They're just kind of there for stability. Filling up tax brackets has to be balanced with ACA healthcare premium healthcare credits. Yes, that's the big caveat to this filling up the tax bracket thing. So for those who are not yet of Medicare age and you no longer have employer subsidized healthcare and you're on your own to buy healthcare, typically one of the most cost-effective solutions is to get a plan from the Affordable Care Act. Now, those plans on the surface are not cheap, but if you can manage to keep your income low enough, less than 4 times the federal poverty level, well, they just changed that with the American Recovery Plan. I forget the specific now, but the point is, if you can keep your income low enough, you can qualify to get a subsidy on your premiums. Now, depending how low you can keep your income, you can get thousands of dollars of subsidies per year. I've seen firsthand people get well in excess of $10,000 of these tax credit subsidies each year. That's real money. Now, doing conversions or doing other things to consciously give yourself more taxable income, that's going to squeeze out some or all these ACA credits. That may not be good. So what's the right answer? It depends, again, like all these answers, it depends on how much ACA credits you're getting. It depends how big your future tax issues are, meaning how big your tax deferred pot of money is. You kind of have to balance and run some projections. But yes, this is the one big time where it may not be worth doing much, if any, conversions because you want to keep your income low to really squeeze as much juice as possible out of these ACA credits. Great comment. Is it correct to assume that filling up tax brackets with income has to be balanced against income for ACA healthcare premium subsidies? Yes. I assume that was the same person. Yes. Dave, where'd it go? Dave Myers again. Yeah, closed-end funds, forgot to mention because I was starting to sweat and I was in a hurry to go open the windows. Another thing, closed-end funds, a reason why they're able to get higher returns and yields is because they typically take on more leverage. Leverage just means you borrow money to buy more stuff. Leverage works really well when it works well, and it works really bad when it works bad. When asset prices are going up and the things you borrowed against are going up in value, leverage is awesome. It takes your return and amplifies it. But it also amplifies it on the downside. When your investments are dropping in value, leverage will make your return even worse. So you have to watch. Closed-end funds typically use more leverage, more borrowed money than other mutual funds, open-end funds. So that's another potential risk with them. But that's what lets them get higher return most of the time. So Dave Myers and more closed-end fund magic. Dave Myers question. Okay. Good. So I didn't see this. So yeah, I'd mentioned before, if you inherit an account from a non-spouse, you have to empty it within 10 years. Up until a few weeks ago, there was no expectation or requirement for there to be RMDs along the way. You simply had to empty it within 10 years. And the IRS made, I think it was an erroneous comment in publication 590B saying you did need to take RMDs. Dave Myers said IRS clarified they messed up. Okay, cool. Thought so. And there are no RMDs along the way. Good to know. Thank you for that, Dave Myers. Okay, more closed-end fund. I'll let that sidebar go. Mavis. Hi, Mavis. Any thoughts about inflation bonds as the bond portion of a portfolio? I'm not a big fan. So I-bonds are basically just bonds like issued by the Treasury that if and when there's inflation, the total amount of interest you'll get from them goes up. Now, all else equal, there's no free lunch. Last time I looked, they pay smaller coupons to start with. So like a 10-year inflation-adjusted bond versus a 10-year normal bond will pay less coupon to start with. But you have the potential upside of if and when there is inflation, you'll get more coupon dollars in. So I don't know. My view is the equity portion of your portfolio. That is your what you have to. What am I trying to say? That should do well if and when there's inflation. So generally speaking, healthy amounts of inflation are a good thing. It means the economy is growing. People are building more. People are buying more. Producers are producing more. That means companies grow, cash flows increase, stock values increase. So generally, inflation translates to higher stock prices. Inflation also means higher interest rates, and therefore bond prices potentially drop, but you should hopefully make up for it in your well-diversified stock portfolio. So my portfolios, and my view is, I don't think you need to get fancy and cute and carve out a specific inflation tool or inflation product, because a well-diversified portfolio should still have some growth when there is inflation. Now, if there's like runaway inflation that is accompanied by like crippling economic declines and stock market drops, well, then we got a problem. Then in hindsight, inflation bonds, I guess, will have been the right answer. But I think I'm no economist, but I think that's a fairly small risk of a dire scenario like that happening. So no, I don't think I bonds are really necessary. Can they hurt? No. I mean, in hindsight, will they be good? Maybe, maybe not. But I don't think they're that compelling that it's necessary to have to do them. Mavis. Glass pack mufflers. Yeah, I guess that's about those loud shooting gun noise mufflers driving down the street. You may all be hearing in the background. No, I do not have a laminating machine. I paid like $2 at UPS for them to do it. Well worth it. But no, it'd be cool if I had one. Yeah, so this was my comment about the ACA credits. It used to be capped at once your adjusted gross income was over, modified adjusted gross income was over 4 times the federal poverty level, you're capped. There's no benefits. They just got rid of that hard cutoff. Now it tapers off beyond that. It's temporary as of now. Like a lot of things in tax code, they start as temporary, but they end up keeping their way in there somehow. So I wouldn't be surprised if this or something like it stays in the tax code. But it is possible we revert back to, once you're at 4 times the poverty level, boom, you're ineligible to get any credits. What is this? Love the weekly lives, especially its mailbag format. Thanks for sharing your knowledge and time so generously. My pleasure. I'm glad you enjoy it. Most definitely has a laminator. No, I wish I did. I do have some weird and cool toys here and at home, but a laminating machine is not one of them. 10,000 limit per inflation bond purchase. Okay, so I mean, I guess per specific issuance, you can only get 10 grand, but I assume there's nothing stopping you from stocking up and getting a bunch of bonds, 10,000 at a clip. Let's see what David Myers has to say about I-bonds. The fixed portion attached to I-bonds issued right now is 0%. The total yield is therefore simply going to be inflation going forward. Total I-bond yield is a combination of, Professor Myers, total I-bond yield is a combination of a fixed piece locked in when you bought it, plus an inflation adjustment. The fixed portion was as high as 3.6% on top of inflation 20 years ago. Now, so okay, yep, now not that compelling. Good to know David Myers doesn't have a laminating machine either. I can see him having one. I'm upset that you don't, Dave. Okay. Yeah, here we go. I'm watching Andy, hubby watching Biden. Yeah, what time is it? Oh yeah, he's on now. If anything news breaking comes out, let me know. All right, any other questions? We are past 9 o'clock, which I'm fine with. I don't know if questions tailed off because that was it, or because Biden is doing his thing now. So I'll stick around another minute or two here, see if anything else comes in. If not, we will give it a wrap. Anyone else has any other random questions, observations, comments you want to throw in? Feel free. Now's the time. Speak now, forever hold your peace. That's exactly it. You can read Biden's comments later. Andy Live is one of a kind. That's right. You can't be asking Biden questions live on air. It'd be cool if you could, but you can't. You can ask me live questions, so take that, President. President. Okay, looks like that's it. Dave Myers, I like you. I don't know how you did it, but I like your Simpsons-esque kind of picture here. If there's some sort of generator that can do that, let me know. I'd love to do that for myself. All right, we're going to wrap it here. It looks like hold on, one more. What are your thoughts on using Roth for education expense? Depends. broader question I would say is prioritizing your own retirement needs or eventual retirement needs versus your presumably your children's or other relatives' education expenses. So different people have different answers. Some people will want to, maybe it was their lifelong goal to go to college and never did. So therefore, now that you have kids, maybe like at all costs, I'm going to make sure my kids go to school. I don't want them having to pay for it. I don't want them to work for it, etc. If that's your priority, sure. If that means taking from your Roth or any other form of savings you had earmarked for retirement, maybe that's the right answer for you. Generally speaking, though, I view it this way. You only get one retirement, and once you're there, you don't have the human capital, the ability to go back and get a high-paying job to replenish. If things go wrong, if you run out of money, whatever. Hopefully you have a good Social Security, maybe a pension, and hopefully you invest in your portfolio wisely and don't spend it too quick. But basically, once you're done, you're done. There's no do-overs. Your kid, your child, presumably, while he or she may not have much, if any, money now, and yes, I think it's disgusting that people take out hundreds of thousands of dollars of debt to go to undergraduate college, but whatever, separate topic. He or she still has a lifetime of earnings that they can, build, grow, recoup, whatever. So if it's going to put you in a long-term bind or a pickle by depleting some or all of your Roth now to help someone pay for college, I'd say probably don't do it. But again, if that's what's important to you, if that's your one of your main goals in life, then fine. Don't let anyone tell you you're wrong. The good thing about Roths is the amount of your contributions, at least, are always tax-free. So if you pumped in $100,000 into your Roth over time and it grew to 150 now, you can always take out that $100,000 of contributions anytime to use on anything, whether it's college or to buy a house or to have a wild raging party. So you have access to it, at least, to some of it, at least. So could it be used? Yeah. If you have no other options, if the person isn't eligible for any other debt or borrowings, you don't want them taking out loans to their eyeballs, then maybe. But there's no single or right answer. But it is a great question. Whoever this was, thank you. Yeah, love The Simpsons. Okay, just see what else we got here. Yeah, Andy's greater than Biden. He went to University of Delaware, by the way, which is this guy, the University of Tickle his foot. Where is it? That's the University of Delaware Blue Hen, Joe Biden's alma mater. Okay, let me just quick scroll. Any other last questions here? What is this? Teresa Wood, late to the party. Thanks for showing up, Teresa. Just kidding. Oh, this is from Tim Driscoll. Sorry. So I guess this was someone else asked a question that I did not see. I don't know why some of these get skipped and I can't see them. But so thanks for bringing this up, Teresa. Tim Driscoll asked, do military and civil service pensions, in addition to RMD, factor against calculating Social Security taxable amount? Yeah, civil service, definitely. Military, I'm not sure. And the reason why I say that, I would assume so, but I'm not entirely sure. I know at least with like the thrift savings plan for uniform service members, if and when they're in a combat zone, they're able to get tax-free contributions, tax-free income put into their TSP that's never taxed when it comes out. With that in mind, I'm just thinking out loud, there may be instances where military pensions may not be fully taxable, in which case they may not count in your how much of your Social Security is taxable. I don't know. That would be a great question, actually, to ask of Brad Bob and his group, the Federal Retirement Planning Group, I think it is. He's much more up to snuff on the ins and outs of federal benefits and pensions. So definitely ask him. Again, Federal Retirement Planning, run by Brad Bob, B-O-B-B. But by default, I would assume yes. I think military and civil service pensions count towards your taxable Social Security. Okay, we will wrap. Andy Pankow for president. Oh, dude, that is not, I would never want to be president. You're damned if you do, damned if you don't. I don't know why anyone wants to do that other than massive ego trip. I guess, I like to think people who run for president have the best of intentions for the public, but it's just a lose-lose scenario trying to be that level of spotlight. All right, thank you all. It was a great time. Next week's topic is, what is next week's topic? Explanation of the 4% rule. That's a good one. Some of you may know about it. Some of you may not. It is a helpful rule. It is not the end all be all, but it is nonetheless one of many tools and things to consider in figuring out how much you can take out of your portfolio. All right, that's it. That's a wrap. I will see you all next week. Take care.